We live in 2026 on a planet that feels more like a high-stakes chessboard than ever before. Nations move like pieces, trade deals and military exercises are the plays, and the prize is measured in trillions. Superpower rivalries between the United States, China, and Russia continue to simmer. Europe scrambles for energy independence after years of dependence on Russian gas. Latin America rides yet another wave of political volatility. The Middle East remains the world's most reliable source of sudden shocks. But here's the crucial point for anyone trying to build wealth. Geopolitics is not just background noise on the news, it is the invisible force that moves markets, inflates commodity prices, shifts currencies, and creates outsized opportunities for those who pay attention. Right now, the Pacific is the most dangerous theater. China keeps pushing its Belt and Road projects across Asia, Africa, and even parts of Latin America, while conducting larger and more frequent military exercises around Taiwan. The United States responds by strengthening the Quad alliance with Japan, India, and Australia. This is far more than saber-whittling. Taiwan manufactures roughly 60% of the world's advanced semiconductors. Any serious escalation would send shockwaves through every industry that depends on chip smartphones, cars, servers, defense systems. Prices would spike and tech-heavy stock indexes would plunge. On the other side of the world, the Ukraine conflict has hardened into a long, ugly stalemate. Russia holds the eastern territories it seized, but has been squeezed by Western sanctions into selling its oil and gas at steep discounts to India and China. Europe, meanwhile, has accelerated its shift toward renewables and American liquefied natural gas. The result is persistent volatility in global energy markets. Whenever Middle East tensions flare, whether from Iran's nuclear advances, Israeli operations, or renewed trouble around Gaza, the Strait of Hormuz becomes a choke point for roughly 20% of the world's oil. A single blockade or major incident can easily push crude prices above $150 a barrel. Elsewhere, the picture is just as interconnected. Latin America sees nearshoring accelerate as companies move supply chains out of China and closer to the United States. Mexico is one of the biggest beneficiaries. In Africa, the contest for lithium, cobalt, and other battery minerals is intensifying, with China holding a commanding position in processing capacity. Climate change adds another layer. Prolonged droughts in places like the Horn of Africa drive migration waves that put political pressure on Europe. The lessons of past pandemics still hang over global supply chains. So how do you actually make money from all of this instability? The core principle is simple. Geopolitical risk creates volatility, and volatility creates pricing dislocations that smart investors can exploit. Start with commodities, because they react fastest and most directly to global events. Oil becomes attractive whenever Middle East risks rise, or OPEC Plus announces production cuts. Energy ETFs and futures can capture those moves. On the flip side, the long-term European push toward renewables benefits companies heavily invested in wind, solar, and grid infrastructure. Gold tends to shine during periods of broad uncertainty wars, inflation, fears, or collapsing trust in fiat currencies, making it a classic hedge. Critical minerals tell a similar story. China's dominance in rare earth processing and battery inputs means any trade war escalation or export restriction can send lithium, cobalt, and nickel prices soaring. Miners and specialized exchange-traded funds in those spaces often deliver strong returns when geopolitical friction heats up. Certain stock sectors are naturally sensitive to these forces. Defense and aerospace companies almost always see budget increases and new contracts whenever tensions escalates, whether in Europe, Asia, or the Middle East. Semiconductor firms outside Taiwan become more valuable as nations race to build domestic chip capacity. Currencies offer another avenue. The US dollar typically strengthens as the world's default safe haven during crises, while vulnerable emerging market currencies can weaken sharply. Beyond traditional markets, alternatives start to matter. Bitcoin and certain cryptocurrencies have repeatedly acted as digital gold. When governments impose sanctions or capital controls, real estate play is tied to nearshoring trends. Industrial properties along the US-Mexico border, for instance, can appreciate quickly. Thematic funds focused on energy transition, critical minerals, or geopolitical risk itself provide diversified exposure without forcing you to pick individual winners. A few practical rules apply, no matter which path you choose. Never allocate more than a small portion of your portfolio, 5 to 10% at most, to pure geopolitical bets. Research matters enormously. Follow credible sources that analyze global affairs rather than just chasing headlines. Timing follows a recognizable pattern. Buy during the initial fear when prices are depressed, and consider taking profits when relief rallies kick in after de-escalation. Above all, remember that geopolitics is inherently unpredictable. You can lose money very quickly if events move against your thesis. In the end, the global chessboard will keep shifting, alliances will form and fracture, resources will become weapons, and crises will appear without warning. Most people will treat these events as distant drama. A smaller group will study the moves, map the risks, and quietly position themselves to benefit when the board tilts. Knowledge of geopolitics isn't a crystal ball, but it is one of the sharpest edges anyone can have in uncertain times.